Hello financial fans, welcome back to another stock analysis. Today we'll be covering Intel Corporation stock ticker INTC. Intel is one of the largest semiconductor producers in the world. They're a multinational technology company that designs, manufactures and sells a wide range of semiconductors and computer hardware components. The company's primary products include microprocessors, which are used in personal computers and servers, as well as technologies such as flash memory, embedded processors, and data center products. Currently, they have a market cap of $124.2 billion, and their revenue in 2021 was $79 billion. The dividend yield is sitting at a very nice 4.89%. From the revenue, 51% comes from their client computing department, 32% comes from the data center department, 7% from the Internet of Things, 5% from the memory solutions department, and the remaining 5% are other departments. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety of 25%, and it can either increase or decrease based on the ratios that we're going to look at in just a moment. The severity that it will increase or decrease by will be determined by our scale. When we're using 4 colors in our scale, bright red will mean a 5% increase to our margin of safety, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction. When we're using 3 colors in our scale, bright red will mean a 5% increase, orange will once again mean no change, and bright green will mean a 5% deduction. The first 2 ratios that we're going to look at are the EBIT growth and the margin growth. The EBIT has gone up from $14.5 billion in 2012 all the way to $22 billion in 2021. It has grown significantly, and the average growth during this period was 8.19%, which means no change in our margin of safety. The margin has pretty much stayed the same, with a few peaks going from 2017 and 2018, but flattening off again in 2021. The average margin growth was only 0.77%, meaning no change in our margin of safety. Next 2 ratios are the dividend growth and the payout ratio. The dividend has seen nice increases, going from 90 cents a share annually in 2013 to $1.46 a share annually in 2021. The average dividend growth during this period was 6.25%, meaning no change in the margin of safety. The payout ratio is sitting at a solid 44.5%, which once again means no change in the margin of safety. The final 2 ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, we have to take the debt, subtract the cash from it, and then divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For Intel, this ratio is only 29%, means that they can pay off all of their debts in a quarter of a year almost. This means a 5% deduction from a margin of safety. The return on invested capital for Intel is 6.3%, meaning no change in a margin of safety. Let's go look at the valuation models next to determine the intrinsic value of Intel. First valuation model we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period was 6.6%. And since we're calculating the lifetime expected growth in free cash flow for Intel, I've gone with 50% of this average, coming in at 3.3%. Using this percentage, we can determine the future free cash flow of Intel going from 2022 to 2030, and then determining a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 9%. Then, summing up all of the free cash flow, we get a sum of free cash flow of $161 billion. To get the equity value, we have to add the cash and equivalents and subtract the debt. Then we get an equity value of $151 billion. And the last thing we need to do to get our discounted cash flow price per share is divide it by the shares outstanding, which is 4,130,000,000 shares. Doing this, we get a discounted cash flow price per share of $36.64. And with the current price of $29.19, we get an upside of $7.45 here, which is over a 25% upside. The second model that we'll be using is the dividend discount model, I've imported the dividend payouts going from 4 years ago to the current year. The average growth in dividends here was just over 5%. And since we're once again doing a lifetime expected growth in dividends, I've gone with 70% of the growth rate that we calculated earlier. This is just above 3.5%. In this model, we'll also be using once again a discount rate of 8.5%. Out of this, we get a dividend discount model price per share of $30.33. And with the current price of $29.19, here the upside is $1.14, which is almost a 4% upside. The last model that we'll be using is the multiple valuation. By looking at similar companies to Intel, looking at their stock price and their earnings per share, we can determine the average PE ratio in the industry. In this case, the average PE multiple in the semiconductor industry is 22.82. The last thing we need to do to get our fair value is multiply it by the earnings per share that Intel is generating. Out of this, we get a fair value of $73.71. And with the current price of once again $29.19, the upside here is a whopping $44.52, which is a 152.5% upside. Let's go look at the final overview of our valuation next. Coming to our final overview, I've imported the discounted cash flow, the discounted dividend, and the multiple valuation price per share. Out of this, we get an average of $46.89. If we were to not use a margin of safety, the upside here would be 16.65%. But we have calculated our margin of safety earlier using a standard margin of safety of 25% and reducing 5% because of the debt to EBITDA ratio. Then we're left with a margin of safety of 20%, leaving our fair value at $37.51. And with the current price of $29.19, our upside here is 28.5%. So in this case, it's a buy. I hope you enjoyed this video. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.